Hi everyone, welcome to IBKR podcast. My name is Elizaveta Gridneva. So today we're back with episode 2 on Japan, and we have Nicholas from Daiwa Asset Management.
Thank you very much for having me back, Eliza. It's to be back and speak with the audience.
Great to have you. So actually interesting developments in Japan since our last conversation. Bank of Japan Governor Kazuo Ueda hinted this week that they might increase rates soon, highlighting that it can happen at BOJ December meeting. Is this how you base case scenario as well? And do you expect big impact on markets?
Thank you very much for the question. So for Daiwa Asset Management's house view, it's been the view for most of the year that the BOJ will hike by 25 basis points sometime this year. And it looks like the hike will likely be this month in December, which is a 25 basis point hike. And even looking at overnight index swap, it looks like it'll be a 90% chance of a rate hike. A lot of investors have been asking us about why Japanese bond yields have been rising, and now it's around 1.9%, which is the highest level since 2007. And we think it for two reasons. The first reason is the reason that you mentioned before on BOJ rate hikes. And also the second reason is on the Takeichi cabinet's massive economic stimulus package. So a few weeks ago, there was an economic stimulus package announced of around 136 billion US dollars, which is more than the market's expectation at 108 billion US dollars. So this is about a 25% increase. And this has obviously caused yields to rise. Now, the reason for the economic stimulus package is to stimulate the economy, and it could be to potentially offset the negative impacts from tariffs. And it also could be used to combat inflation and support the consumer. The market is concerned how the Japanese government is going to finance this. And in this case, the Japanese government will issue bonds. As they have issued bonds to finance this, it means there are more bonds supply circulating in the market, which means yields tend to rise. So I think that's the concern for the market at the moment.
Great answer. Thank you, Nick, for the detailed answer. In the next question, I think I want to ask you about investors' base in Japan. So firstly, do you see any meaningful difference in investment approach if you compare domestic investors versus international ones? Do they probably focus on different sectors, different investment time horizon, or stock profiles?
Sure. When it comes to investor preferences, especially from rising yields, I think foreign investors have been overly cautious and more concerned about these rising yields and how it might affect their investment, which is fairly different to domestic investors. Given that foreign investors focus on debt to GDP percentages, Japan obviously is the highest in the world, and the debt to GDP ratio in Japan in 2020 was around 260%, but in the last 5 years it's come down to 230%. The big difference is looking from a domestic Japanese investor's perspective, their view is less negative or less bearish because around 90% of Japanese debt is owned by domestic Japanese investors and only 10% is owned by foreign investors. So when we do a breakdown, around 40 to 50% of the domestically held debt is owned by the Bank of Japan, and the rest is split between deposit-taking institutions such as banks, pension funds, and even insurance companies. For domestic Japanese investors, it's a little bit different because when it comes to, it's almost the government is lending to itself, left pocket to right pocket. And when it comes to foreign investors, their major concern is that if borrowing costs start to rise, it means the government may not be able to repay their debt and potentially default.
Understand. And coming back to our last episode, we actually covered a range of investment strategies. So what are some of the strategies of interest today for investors?
I've been very fortunate to work with investors across the Asia region this year, and the most popular strategies that we've been receiving feedback from investors defensive type of strategies such as dividend strategies and real estate related strategies. The reason why investors are looking at these type of strategies is given that there is global uncertainty, potential political tensions, and increased volatility. Investors have been looking at these strategies due to a few reasons. The first reason is they're looking for some sort of income. The second reason, they're looking for diversification. And the third reason is they're just looking for something with lower volatility overall.
Understood. And can I ask you to share an overview of the high dividend strategies?
High dividend strategies have been really popular inside Japan and outside of Japan this year. And this is really off the back of corporate reforms in Japan. A lot of corporates have been holding too much cash, and paying a higher dividend is incredibly beneficial for shareholders. When we look at dividend forecast for the next year or two, the average dividend per share growth rate is forecasted to be around 8 to 9% per annum. So there is a healthy amount of dividend growth in the next couple of years.
Understand. And my last question, could you share an overview to Japanese REIT strategies?
Yeah, when it comes to Japanese real estate investment trust, or J-REITs for short, these have also been incredibly popular this year. The major difference between Japanese REITs and global REITs is that for Japanese REITs, the sponsor is not allowed to develop or essentially refurbish the underlying properties, whereas for global REITs, they are able to redevelop the underlying properties. The behavior between Japanese REITs and global REITs is quite similar. Usually, if interest rates start to rise, this can be negative for Japanese REIT, which is also the case in Japan. However, this year, Japanese yields have started to rise up to 1.9%, but also Japanese REITs are up around 20 to 25% on a total return basis. Now, the reason why Japanese REITs have been, or the correlation between Japanese REITs and yields have broken down this year for a few reasons. The first reason is Takeichi being elected as a new leader. This is positive for REITs given that view is more dovish and there is a chance of slower rate hikes, which is positive for REITs. The second reason is valuations. For REITs, most people look at price to net asset value, or NAV ratios. And currently for J-REITs, they trade at around 0.9 times price to NAV, which is at a slight discount. Historically for J-REITs, they have traded at 1.1 times price to NAV over the last 20 years. So if an investor is looking to gain exposure to Japanese real estate, they could directly buy real estate. However, they may pay a premium. But if you do buy it through, for example, J-REIT strategy, you can acquire this or gain exposure at a discount. And finally, the last reason is that from a fundamental perspective, inflation is helping J-REITs do well. So when we look at subsectors, such as the retail sector or even the residential sector, usually for tenancy agreements, when they roll or unlock every year or two, inflation has been able to increase the rent every time they lock in a new contract. And surprisingly, when it comes to longer term subsectors such as the logistics sector or even the hotel sectors, the sponsors have been introducing inflation-linked or CPI-linked tenancy agreements, which means that these longer-term lease agreements over the 3-year, 5-year, or 10-year time horizons are able to benefit from inflation.
Great. Thank you, Nick, today for your interview. Always informative, detailed responses. I learned quite a lot today.
Thank you very much for having me back, Eliza.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Alternative investments can be highly illiquid, are speculative, and may not be suitable for all investors. Investing in alternative investments is only intended for experienced and sophisticated investors who have a high risk tolerance. Investors should carefully review and consider potential risks before investing. Significant risks may include, but are not limited to, the loss of all or a portion of an investment due to leverage, lack of liquidity, volatility of returns, restrictions on transferring of interests in a fund, lower diversification, complex tax structures, reduced regulation, and higher fees. All forms of investments carry risk. The price of a financial instrument/product may move up or down and may also become valueless, and you may not get back the amount you have invested. Any discussion or mention of financial instruments or products is not to be construed as a recommendation, promotion, or solicitation. The information provided is of a general nature and has been prepared without taking into account any person's financial circumstances, situations, or needs. Past performance is no guide to its future performance. Please note that not all investments in financial instruments/products are suitable for everyone, and certain products are riskier. You should carefully read and consider the relevant warnings and risk disclosures available on our website with consideration to your investment experience, financial situation, investment objective and risk tolerance level, and consult your independent financial advisor prior to making any investment decisions. Pursuant to Part 7.8A of the Corporations Act 2001, Interactive Brokers Australia Thai Ltd has prepared target market determinations relating to certain financial products for which it is deemed to be the issuer. Our target market determinations are located here. Target market determinations. Product disclosure statements are also available for each of these products. If applicable, you should carefully consider these disclosures in deciding whether to acquire or to continue to hold the relevant financial product. This publication has not been reviewed or endorsed by any regulator, including, but not limited to, the Monetary Authority of Singapore.